All right, welcome back, guys. So today I have a very, very special guest. Now, if you've been following me on Instagram for a while, actually, no, a couple of weeks ago, I put a poll out there asking for any tax questions from the eCom guys that follow me and also the online business owners that follow me, because I have a Q&A session with one of the best tax professionals when it comes to the e-commerce space out there. So this is Alan. He is a certified public accountant, needed to get that right. And he's one of the founding partners at Free Cashflow, which they're basically a consulting agency based out in LA, in California. And they only work with online business owners and e-commerce. I've worked with tax consultants in the past and accountants as well. And they come from a slightly more traditional background. So what you'll find is when you're trying to expense like an online course or anything that's actually like necessary to run a digital business, they're going to question the crap out of you, right? So I wanted to bring Alan on today because I wanted to show you guys someone who actually understands tax compliance, accounting, auditing, and things like that with regards to the online space, because it is, in fact, like hugely different. So to give you a bit of an idea of like Alan's credentials, he's helped EY Riot, which is the video games company that I think produced GTA, right? Or is that?
They produce League of Legends.
Oh, okay, yeah. Oh yeah, Rockstar Games. That's the other one. Yeah. Disney and Paramount, and they offer a all-inclusive package for all of your business tax planning, sales tax filing, etc. So he's a real expert in this space. They have a money back guarantee, but I'll let him introduce his own business to you and we'll jump right into the Q&A.
Hey, Boyuan, thanks again so much for that great intro. Hey, everyone out there. My name is Alan Chen. I'm a certified public accountant, and we're located in Los Angeles, California, here in the US. And just like Boyuan said, we basically offer what we call an all-inclusive package to basically take care of all your compliance needs, right? And we only serve one niche, just online and e-com businesses, and we're really focused on it. And what our competitive advantage, I think, over what we call a generalist or just an accountant that you may hire out there, is that because we're laser focused on just e-commerce online business, we have a lot of data that we use to do comparatives from one online business to another to ensure that you always get the maximized tax savings that you deserve out there. And given that me and my partner Stanford's background in a lot of Fortune 500 and big businesses, and I'm sure you guys heard in the news out there, like the Facebook and Google of the world is how they're able to pay little to no taxes. We like to think that we're able to take some of the things we learned from that and be able to apply to your business and say, hey, the tax code is for everyone, and you guys should be able to take a piece of that pie and apply it to your business and also take advantage and make sure you keep more of that money back in your pocket.
Yeah, for sure, Alan, because having comparative data across the same industry is so important, because it's basically the same with anything out there, right? Like a lot of what gives a lot of specialist businesses our edge is basically just like we work with everyone. So it's like, right, hey, we have niche specific knowledge. So yeah, let's jump into some of the questions I got asked on Instagram.
Okay, awesome.
So I believe Jason asked this. He is currently living in EU, but wants to sell and scale his product in the US. What would you say is like the best state to set up a company and have a strategy based out in the US?
Yeah, that's a great question. We actually just signed an Australian e-commerce company to the agency, and they basically have those similar question when we're going through the due diligence process with them. And basically what we advised them was that, if you guys are looking to set up in the US, there's a couple of key reasons why you want to do that, right? One of them is you probably have a high concentration of US customers. And because of that, you probably are getting kicked in the butt with foreign exchange rate fees that you're probably getting hit with in your bank account. And another is you're probably trying to say, hey man, these US e-com owners, they get great credit card benefits that I'm not getting because I only work in the EU and my credit card program sucks in the EU, right? And it's like, how do I get these points? I see all these Instagram people are on first class flights and hotels and lodging. How do I get some of that? I'm running just the same, similar, 7-8 figure business at this point. So because of those reasons, a lot of ecom owners from outside the US are attracted to start a US LLC at this point. And one of the key benefits and advantages that international has over, say, like me, who's domestic in LA, is that they can choose any state they want to start their business, right? Like I'm physically located in California, so I'm forced to start a California LLC. But don't do that. California LLC sucks. We pay some of the highest fees for setting up a corporation in all the United States. Like I can literally make no money this year, Boyuan, and I have to pay $800 in a franchise fee to the state of California. I can make no money and I still do that. So anyway, for international guys, because you guys can choose any state to incorporate in the US, the 3 most recommended state to do that, one is Wyoming, one is Nevada, and one is Delaware, depending on what kind of business structure you're trying to do, right? And the reason why these are the top ones is because they provide benefits as low fees, ease of setup, and sometimes also you get to be anonymous, right? And that's important to some of the business owners out there, is they want to be not very tied or linked up to their business in the US, because they also like, hey, if things all go down the gutter, how do I make sure I disassociate from with business? Right? That's worst case scenario, but sometimes they do still want to be anonymous, right? So those 3 are the most recommended ones, and and especially Wyoming and Nevada, they have no state income tax too, so you have nothing to worry about that. If anything, you just have the federal part to worry about. Gotcha.
Yeah, the anonymity thing I know is quite important to dropshippers. I think Delaware might be the move for them, right?
Yeah. So Delaware is a very well-known state to set up your corporations. It's like most well-known, I would say, in all states, right? Yeah. The reason is Delaware is just so business friendly. It's like the first state to be like, hey, everyone come set up a business in my state, right? And they're best if you're trying to set up what they call a C Corp, right? Okay. If you're doing a C Corp, you want Delaware because that's where all the big businesses to go, right? All the Facebook, Amazon, they all have a Delaware C Corp, along with maybe their in-state one, right? So, and the reason why you want to go C Corp is they just have the most loose rules over like board members, over your like a statement organization, all those things. They just say, hey, just fill a couple of things and you're done, right? Because no one want to be burdened by paperwork. And some of the other states are like, yo, you got to do all like 50 forms and all that stuff. State of Delaware is like, yeah, you can take care of this in 1 week. Just pay us our fees,
That's dope. That actually brings me on to the second question, actually, Alan.
Yeah, for sure.
Asked also, what's the difference between like the different legal structures? So S Corp, LLC, and C Corp as well, as you mentioned earlier. And also for the what would you recommend for the different types of e-commerce stores out there? So for example, if you're like or like online businesses, so if you're an agency owner, or if you run a legitimate e-commerce brand where you have in-house products,
right? Or
like the typical kind of like drop shipper.
Yeah, that's a great question, and one we get a lot at our agency. So I guess just to go from the foundation and we'll build up, is that when you start a business and you just go into it like without even registering as a company, right? What you are known as is you're just a sole proprietorship, right? Where you're running the business as yourself and you're representing the business 100%, right? And that's fine, but for just starting out, like you're just trying to test the e-commerce niche, right? Where you're just trying to test how to run an agency, right? And then you're like just trying to dip your toe into it. But this is where I recommend that as soon as you scale at all, right? At all, I will recommend you start immediately go with an LLC. Why? What an LLC stands for is limited liability company. And what that does for you is, like the name suggests, it limits your liability in the business, right? So what happens here? So say you sell some kind of battery product. The battery leaks, right? And it hurts a child, right? And what is that consumer going to do? Well, they're going to sue your business, right? And if you are just a sole proprietor, then what they're going to do is they're going to go after everything you own, right? And what does that mean? That means your personal assets. Like if you have a house, if you have a car, if you have any kind of asset, they'll go after it all if they can. Now, you don't want that to happen to you. That's a nightmare scenario. So what you want to do is you have an LLC set up, it limits the liability of what you are going to have to pay if you get sued or you go into bankruptcy situation, so that they can only go after your business assets, right? And if they're going to business asset, which means all your personal stuff is safe, right? If you own a boat, they can't take your boat, right? They only go after your business assets. So that's why it's the most recommended setup. And because an LLC just has the most simple setup, right? It has the most the least paperwork to deal with. You don't have to do a lot of like the board directors things. You have to do like a C Corp. So I'll go into that too. So after an LLC, the next step, I would say up from LLC, is an S Corp. What an S Corp is basically a hybrid of an LLC and a C Corp, right? C Corp, you can think of it as like the most official business setup you can do, right? All the Fortune 500 companies, they have to be a C Corp. And at a certain monetary level, you may also want to just default into a C Corp. We can go over that too. But starting out, you want to be LLC. Now, what an S Corp does that you wouldn't get as an LLC is S Corp has something that's very special in that when you are a business owner, especially in the US, you have to pay what they call a self-employment tax, right? Because you're a business owner and US government finds all kind of ways to tax you. The self-employment tax, Boyuan, is about 15%. So that is pretty big, and that's on top of the federal and state and sales tax and all the other things you have to pay, right? And so what the S Corp does is it kind of lets you avoid some of that self-employment tax, right? But basically, when you're in an S Corp, you get to say you get to declare that you yourself is an employee of your company. And as an employee of your company, you can avoid half of the self-employment tax, so about 7.65%. Now, here's where it gets a little bit complicated. You have to come up with a reasonable salary for yourself, right? You have to say, hey, I'm doing this and this for my company, so I think I should take a salary of 70,000, right? And let me give you a real world example. So say your company's doing $1 million, say your net margin is around 20%, right? So your take home after a year is about 200,000. Now, normally all 200,000 of that net profit will be subject to that 15.3% of self-employment tax. Now, if you're an S Corp, only half of that, so only 7.65% of that is now subject to it. But beyond that, you can actually take a piece of that 200,000 and say that's your salary, right? So say you think you're worth about 80,000 a year as an employee of your company. That means only that 80,000 now is subject to self-employment tax. The rest, the 120,000, it's just going to be a dividend to you as a business owner, right? So think about the impact as your business grow, and you can avoid 7.65% of whatever your net profit is. But here's a little part where you might want to hire a professional, a CPA or an accountant to figure out for you is you can't just come up with a number off the blue, right? Because you're probably doing the math right now. You're like, okay, if 80,000 is subject to the self-employment tax, why don't I just make $1 a year, right? Why don't I just say I'm like Elon Musk. I don't want to take $1 salary and the rest I want stock options, that kind of setup. And that's the thing. The IRS is going to go hard on you if you do that. It's like, no one should only be paid $1. You're not a CEO of a Fortune 500 company, right? So you have to come up with what they call a reasonable market value of whatever skills you think you are contributing to your business. And that's market comparable to other people at your level doing the same thing you're doing for your business. Yeah. So that's why that number is key, because the IRS will audit you if you come up with the wrong number, right? So that's why a lot of companies I have seen, especially the agency ones, like switching to an S Corp for that reason. Now, a C Corp is the reason. So C Corp is very complicated because there's a lot of paperwork involved, right? Just a lot of things you got to set up. And a lot heavier fees, I would say. So I would say anyone starting out, don't go C Corp, go LLC. C Corp is say you have scaled to 7, 8, 9 figures, and at this point you're actually trying to raise money, right, to grow your business even bigger, legitimize it, or you're trying to exit the business, right, because you want someone to value a business, have a valuation done. A C Corp basically subject you to a lot of what they call like financial regulations. And you have to go do audits of your business, right? Yeah. But because of that, you're very legitimate. Anyone going in to, do due diligence on your business, wanting to, basically buy you out, are gonna be more trusting that, you're running a legitimate business because you are a C Corp. And that's really the stage you kind of want to go into a C Corp, is when you are thinking in those directions. You have those goals in mind of either exiting your business, getting acquired, going to a merger, or just trying to go take your take a company public, possibly. Gotcha. Right? Those are the routes why you want to go C Corp. So for anyone just starting out, if you're especially if you're in the 6-figure range, right, 5-figure range, go LLC. Once you do have a substantial amount of profit in your business, try to look into if SCorp is the right move for you. And then of course, once you blow up, man, you need that C Corp. You need that C Corp setup for sure.
Sure. Yeah, because I have a few friends with like a finance background, and they said more on the like hedge fund and like investment banking side. And they were basically saying like, yeah, there's actual value for having like Cayman entities and stuff that increases the valuation of your company. So I guess I didn't know that C Corp was basically the equivalent of that. Like, would it actually increase the valuation of your company if you were to, let's say, want to exit a store?
Yeah, so I have noticed that I would say, like, if you get to that point, I'm sure you'll hire like a lawyer or some kind of advisor that will tell you, hey, you got to switch to a C Corp, right? Because staying as LLC means that your numbers are what they call unaudited, right, in the world of finance, right? It means that you can literally go in, like, say, an accounting software that where you're keeping your balance sheet, income statement, change whatever you want, right? Say you just pump up your revenue by 50,000, right? Or change your expense in a certain way. No one's verifying those numbers are correct. That's the problem in an LLC, right? In a C Corp, those things are regulated, right? They're expecting you to go to an audit, right? So a third party. So the company, so I started out my career as an auditor, right, at Ernst & Young. And that's all we did. We go into these Fortune 500 companies, and we're like the third party verifier. We're telling any investors, stockholders, hey, you can trust these numbers because we audited them. We tested these numbers that are correct, right? Doesn't that, you as an investor, that's give you more trust than, and then you're in like small business LLC that you're trying to invest in, and you're like, oh, I'm supposed to trust that this is how much money you made? How do I verify that? When it's you don't have a third party person saying this is right, this is true, right?
I see. Gotcha. Yeah, that's actually super interesting. I had no idea the differences, because I think in the UK we only have like like sole trader, which is sole proprietorship.
Yeah,
and then
that sounds equivalent.
Which I think it's the limited company is LLC.
LLC.
I don't know if we have like S or C Corp. Pretty sure we don't.
Oh, really? So you only have two types of entities you can declare as a business in the UK?
As far as I'm aware of, or maybe I'm just not at the level where I can learn. I shouldn't be learning about the other kind of like entities then. Okay. So another question I got asked on Instagram, and I think this is how to legally evade tax. I think they mean like tax avoidance, because evasion is always illegal. Yeah,
evasion is like I have big reaction, right? Evasion is like a word you don't want to use, right? Evasion in the sense, in the very definition, is you're trying to escape paying taxes, right? It's usually have a negative connotation to it. So what this person really want to do is like how to defer tax, right? Or how to not pay as much, how to minimize their tax obligations, right? And that's really the two strategies that I would say that they should do, right? So one is how to minimize. How to minimize is really about education and knowing the tax code, right? Knowing every single tax deduction available to you, to your business, especially understanding your specific business setup, whether it's e-commerce, whether it's agency or another type of online business, what's available to you. And then of course, understanding the credits that's available to you. Like, let me give you a big example. During COVID last year, right, when we're helping our clients do their tax returns and all that stuff, like randomly, not even randomly, just because of the state of the world it was in, there was all these COVID credits available, and some of these are crazy, and it was so easy to be qualified for them. One of them is literally, if you feel yourself being in danger of getting COVID, or if you feel like someone might give you COVID while you're running your business, this credit basically lets you take sick leave and they'll pay you for it. They'll pay you to take sick leave from your business and pay you, I think, a maximum of 10 days. So you just get a credit for that. Like, I think it was like, it can be up to like $3,000 back for your business, just because I just asked my client, hey, at any point of the year, did you feel like you're in danger, like the COVID posed a danger to you? They're like, I guess it did. You know, I guess I feel I might get the virus. Great. That's the answer I wanted. I don't want you to say no. If you say no, I know legally I can't take the credit for you, but if you feel like you're in danger in any way and you wanted to take a day off, go for it, man.
It's 3,000.
There's a credit for you. But now you've been like, I as a CPA, I ask the questions, but then the client provides the answer. So if they feel like they're in danger, if they feel like they need to take 6 days off, hey, I'm gonna find that credit for you. Make sure you get your maximized tax return, right? So there's things like that. I'm just like, hey, you don't want to miss out on that. If you're just not educated, not keeping up with the tax laws, that's just an easy $3,000 you're not getting back for your business, right? So that's one way. The other is, of course, deferral of tax, right? And there's a lot of different ways you can look at deferral of taxes. One thing is the US has a lot of programs, what they call retirement programs, right? That's built into the tax code, where basically you can take a chunk of your income and basically you can not pay that chunk now and pay it later and actually use it to fund your retirement account, right? One of the best kept secrets of what a business owner can take care of is what they call a solo 401k plan. A solo 401k is only available if you're just a single member owner of your business, right? It doesn't work if you have like multiple partners in your business. If you're just a one-man show of your business, basically it allows you to take around $56,000 of your income and defer it and not pay taxes on it in the current year, and then just pay it later on when you take it out for your retirement. So basically you get to save the money now, put it into a retirement account, let it grow, right? Put it in some kind of mutual fund or ETF, whatever you like. And then later on, when you actually retire, that's when you'll get taxed on it. And hopefully by then you already exit your business, and your taxable rate is actually much lower than when you're running a 7-8 figure business, and it doesn't matter to you. So, but for the time being, you get to take $56,000 out of your business profit and not have to pay tax on it, which is incredible, right? So I think what this person's looking for is solutions like that to help them, not pay as much tax obligation this year.
Yeah, because so I'm guessing because it's like a 401k, I said cake, because it's a 401k, then you don't need to pay capital gains on that as well.
Yeah, no, like if you're deferring your income during the year, yeah, there's no tax that you're paying for that amount, right? Gotcha. Until much later when you actually retire, and then you want to take that money out, right? That's the only point you would get taxed on it.
I see. Because one of the things I was looking into, and on YouTube, all of the resources are specific to the US. I saw something where it's like the Agatha loophole, where you could like rent out your own home to.
Oh, the whole like 10 days thing. Yeah, that's something you can do for sure. I know what you mean. Is the Airbnb loophole is what they call it, right?
Yeah, for sure. Another few questions I had was around like best countries to structure for tax, and also at what point, like profit wise, should you start thinking about like maybe moving your business to another country or denouncing your citizenship, stuff along those lines. Yeah, I would love to get your thoughts.
Yeah, that's a great question, and it's going to be a little long-winded because like country by country, this applies to you so differently. So I'm just going to talk strictly on the US side. So for anyone who's US, I would definitely pay attention to this part. So if you are a US citizen, right, you're a little bit screwed, just because in the US, they have hands everywhere, like it literally does not matter where you're located in the world. The US wants to tax you on it. And that's what they call taxing on your worldwide income, right? Now, what your US person usually are jealous of other countries is because they're set up as what they call a territorial tax system, right? You can think of that as like Singapore, Hong Kong, those type of countries where they only tax you for the income that you make in that country, within the borders of that country, right? So if you say you're an eCom owner in Singapore, right, and you make a sale in the US, Singapore doesn't care. Singapore only cares that you have a customer in Singapore and that guy pay you money, that's when you have to pay taxes. Crazy, right? US is saying, I don't care where that customer is. You made that income, you have to pay. Or I don't care where you're located anywhere are. You can be in Sweden, you can be in Japan, you can be in any country running your business. As long as you're a US citizen, we're still taxing you on that, right? Now, a way to, I would say, get away from that is you have to go and neither one is denounce your citizenship, right, from the US, or two, you have to go and buy a tax residency in another country, right? So there's a lot of countries that can help you do that. I'm just going to rattle off some couple things that will let you do that, right? Costa Rica, Dominican Republic, the United Arab Emirates, Panama, Malta, Switzerland, Cayman Islands. They all have different amounts. I know Cayman Islands, I think you have to make a $250,000 real estate investment, and then you get like a sort of a long-term residency into that country. So there's different ways you can set up your business outside the US and not be taxed as heavily. So what you would do is you have to go do this complicated, not complicated, but you have to go do this business structure way, right? Where you kind of move your parent company into that country, establish long-term tax residency in those countries, and then you start not having to pay the crazy US tax rates, right? Like some of those countries I named are neither low tax rate, like 10% or less, or no tax rates at all. So there's definitely an advantage of moving your business outside. But I do want to mention something, man. Some of these countries are not the best for living. Like I feel like once you're like in the US or UK, you have a certain like standard of living that you want to have. And some of these countries are, they're like a little bit borderline, like third world country a little bit. They don't not have all the amenities you're used to. So you also have to balance the living environment, I would say, when you do make such a big move as moving your country and permanently being over there, right? And and then I know your second part of your question is kind of like, what at what profit level, right, would you go to one of these countries? I mean, yeah, it obviously US is one of the higher tax rate countries in the world. So I would say anytime you have start making above 500,000 in net profit is when you start thinking about, hey, do I need a more complicated tax structure entity wise where I don't have the US as my main parent entity. I want that somewhere where it's more tax saving, and it was very commonly done, right? Where a lot of big corporations they have a web of a corporation set up everywhere, right? They have one in Malta, they have one in Ireland, right? They usually have one in one of the islands down there, and that's the whole reason, right? They usually tend to, especially if they have customers in those countries, and like say Europe, they will leave the profit outside the US, right? They will leave the money outside the US and never bring it back into the US and thus get taxed. So that brings into a whole different setup that you have to go through. And I would definitely say you make sure that's worth it. Like you make sure your business is at a point where you are constantly bringing in very large 6-figure net profits before you start going down that path, because it does bring in a lot of fee like structures you got to set up to make sure that you are going down the right path and you are actually getting enough value, right, benefit of doing that, moving to different countries and setting up.
Sure. So that kind of brings me on to the next question then. So in terms of like, what is the most efficient way to take profits from your business and kind of like reduce your tax burden the most? Because I think with most people watching this, and for me as well, what's more relevant would be like, say you're at around the 1 to maybe like 1 to 500K a year profit level, where it doesn't quite make sense for you to kind of like move elsewhere, but your tax burden is still like you're still getting rammed, right?
Yeah, ram is a good word.
What would you say is like a really efficient way from taking profits from the business? Because one thing I did last year, I should have actually taken way more profit last year in like the tax year.
Yeah.
But I was like, oh yeah, I was like, oh, I'm gonna keep all the money in the business and reinvest it in. But I feel like with heavy cash flow businesses, then there's not much areas that you could actually invest in. So how would you take profits, and also what percentages or ratios do you like to follow?
Yeah, it's a great question. And there's a lot of strategies behind correctly allocating your money out of your business for maximize tax efficiency, right? And the number one way you kind of already mentioned, Boyuan, is leaving it in the business is one of the most tax efficient ways, right? So if you can find a way to reinvest that money, that's great. If you, number two is if you can find a way to diversify, that's great. And what I mean by diversification is, you're running an agency, right? Or you're running eCom. Is there a way you can use that money to buy another business? That's tax free. Is there a way you can use that money to buy real estate and become a landowner, right? To rent out properties or go into the Airbnb business? Is there a way you can put that money into stocks and bonds, right? Is there a way you can diversify your money so then cash turns into investments, right? Because I think you mentioned earlier on this call about capital gain rates, right? Capital gain rates is a lot lower than what you get taxed on as an ordinary tax rate, right? So if you're an LLC, all that net profit usually just pass through, what they call it. They pass through to you on your personal tax return, right? And then you have to pay a very high tax rate, up to 38% in the US, right? But then if you can find a smart way where you're, finding ways where you can find other vehicles, capital tax rate vehicles, right? Like stocks, bonds, invest in paintings if you want. I think some of my clients even are doing like crypto, right? That's very popular. That's a very popular thing right now. Freaking NFTs if you want, have some Pokemon cards.
I just
Pokemon cards, like the whole NBA thing, No, but seriously, that is a strategy right now. Is don't take it out in cash, put it in other things, and then I'm not sure if you heard what they call so one of the problem with real estate is they're like, hey Alan, what happens if I need to sell this? When I sell that real estate, doesn't that turn to cash again? Well, the strategies for that, the rich is not gonna pay tax. They come up with things like, so one of the strategies that you can use is what they call like-kind exchange. Like-kind exchange. Like-kind exchange.
Okay.
Yes, like-kind exchange is a very high net worth strategy, right? Where you have a property and you don't want it anymore. You want to sell it, right? But instead of just directly selling it for cash, what you do is you put it into a marketplace facilitator system and you exchange it for another similar property of yours. So say you own one in Miami, you can go and get a similar property that's valued around the same amount as your property in New York. And instead of any cash changing hands, you're basically it's like Pokemon cards. You're just trading places.
Gotcha.
You're just trading places with another guy. And there you go. You just have a new property, but guess what? No cash change hands. You're like kind, right? You're changing the same kind of property with another kind. And that's a great way to defer tax, right? And you can keep doing that, right? Now that you have your New York property, 10 years later, you're like, nah, I'm good with New York. I want to go to California. You keep doing that. So then eventually, you really just it gets to a point where you're going to like estate tax, estate laws, right? Where you're passing it down almost to whoever wants to inherit that property. And you got to figure out that part. But for you never possibly had to pay tax on it ever, on this $1 million real estate investment that you put in, right? But then that property is maybe it's been generating rent income for you the entire time. And that's a whole nother subject. There's a lot of great real estate tax deduction you can take. And why real estate is so attractive is that there's a lot of tax deduction you can take when you're doing real estate, right? One of the primary one people may talk about is depreciation, right? The hidden deduction, what they call it, like the one that's like not really easily explainable, but all real properties in the US get to take depreciation for the wear and tear on that property, right? So that's what I would really suggest. If you really have to take money out of your business, you can, but the tax rate is gonna hit you, right? And then of course, if you're international, I would say find ways to avoid the foreign exchange rate, which can be as much as 3 to 10% more your profit going into that. You try to avoid that, right? So if you have a high concentration of agency or eCom customers in the US, definitely set up a US LLC. So then you have like US Stripe account, US PayPal set up. So then all your customers, when they hit that and then it will go to your US bank account, and then you never get hit with foreign exchange rate, right? And then you just use that money to fund your expenses, right? So then you never have to take it out to your home country, thus never hitting that foreign exchange rate. And really, that's a 3 to 10% add to your net profit at the end of the day.
Gotcha. So would you say, so one of my clients actually is, they're struggling with their bottom line. Like they want to, they're trying to grow quite aggressively. And I don't want to go into too much detail in terms of like how much they netted, but it was like, it was like sub 5% net last year.
Dang.
Would there be opportunities for them to boost their bottom line to, let's say, the 10 to 20% range through just like tax deductions and like, I don't know, like loopholes or just a better tax planning strategy?
Yeah, absolutely. Absolutely. So I do want to mention this, that tax strategies super important, right? It really can boost your profit by another, 5 to 15%. Like that's just what we've seen from all the ecom business and all the data we have. But before you even get to that point, what you need to establish for your business is actually clean bookkeeping, right? You got to know your numbers. We get on calls with a lot of business owners that when we ask them, hey, how much sales you have last year? I was like, I think around this. Oh, okay. How much, what is your operating expense? Oh, I think I have 10,000 for ads and 20,000 for payroll. Like they don't know their numbers. And then I'm like, how much money are you taking home? It's like, I think I have enough, I'm still running my business. Like they just don't understand their numbers. And that's a very dangerous game they're playing. Very dangerous game. They're going to eventually get into cash flow issues, right? If they're trying to expand their business, because they don't know how much cash they have on hand. They don't know how much cash they need to keep in the business to keep it running, and how much they can safely withdraw, right, for their personal enjoyment or just living expense, right? And what I'm trying to educate a lot of clients on is you need clean bookkeeping, because you want to know your numbers, you want to know your margins, so you know that are you actually running a healthy business, right? Like this client you explained to me, he doesn't seem like he's running a healthy business at all. 5%, no, there's no way you can sustain that, right? That's dangerous. That's like you're near broke even, right? And then what's the point of working so hard, being an entrepreneur, if you're just going to be taking home 5%? Am I right? Sure. This person, I would say he needs to do a thorough audit of his financials and see where's the leaks are. Why is it that he's only taking 5%? Is it because his cost of goods sold is too high? Is it because there's certain winners and losers in his product mix that's actually dragging him down? Is it because he's not doing a great job running Facebook ads? His payroll is too high? Where's the leak? Why is this business at this point, right? Is it too much fees he's paying? Is it too much transaction fees, right? Is it because he's dealing with foreign exchange rate fees, right? What part of his business is actually dragging him down? He needs to understand this part before we even go to the tax part. The tax is kind of like the icing on the cake of you running your business well day to day and understanding your numbers, right? And then once you have clean bookkeeping, it makes your tax life a lot easier, because that's what you do, right? You take the numbers from your clean bookkeeping, and then you know how much tax saving you're going to realize at the end of the day, right? Yeah. So I'm gonna go on a tangent here, but this thing really makes me like irritated. Is like a lot of people think like they can come to an accountant like April 10, right? In the US, taxes due April 15, and they're like, hey, figure it out, get me maximized tax savings. That's impossible. That's impossible, right? Not because you only give him 5 days time, that's already bad, but because all the tax planning takes place actually during the tax year, right? If you think about it, this past year, April 15, 2021 is when your taxes are due. Well, this year is with the pandemic, it's May 17, but same concept. Your tax year that you're filing your tax for is January to December 2020. Does that make sense? So really all the tax planning should have gone on during 2020, right? So like when we pick up a client every month, when you do a consultation call with them, we give them a tax recommendation report of saying, hey, these are the things we've seen from doing your bookkeeping, from doing your financials. These are the tax recommendations we think you should utilize, right? And then they start changing their behaviors, changing the way they run their business, make it more efficient, increase their margins. And then by the time we get to the end of the time, we're like, hey, there's no surprises. You're going to get a huge amount of tax savings. So you're doing all the right things during the tax year, right? So that's what I'm so like, so like irritated when a client like expects like when I get calls in April, I know what kind of clients they're gonna be. They're gonna be like,
Sure.
oh man, here's all my numbers. Here's what I did last year. Yeah, make magic happen. Magic doesn't happen. There's some last minute things we can do for you, but
All right.
most of the stuff, if you didn't do enough tax planning during the year, that's it.
Yeah.
That's it, bro. You're GG. You know.
Yeah.
Like
I
seriously,
have
you know?
I have a call with that client this Thursday. I'm definitely gonna make the introduction for you just because, man, like I want them to succeed from a numbers perspective.
Yeah,
'cause
they
trying-
gotta know the numbers. They gotta know numbers. 5% is
Sure.
yeah. I hope they're not like pulling in like, you know, burn the midnight Oreos to make that 5%, you know.
I think
A lot of entrepreneurs are.
I think that's like including R&D and everything, but to be honest, I don't know. I don't know how accurate the number they gave
It's,
you was.
it's okay that you don't know Boyuan, but it's not like he knows.
Yeah.
If he
Yeah,
doesn't know, then we're in trouble.
For sure.
He doesn't know.
So to loop back to the original point,
For sure.
Before going on this tangent, it's really interesting that you brought up crypto as a way to reduce taxes, because so the only investments I have right now is I bought a watch as like a low risk asset.
Oh,
So
like a
it's
Rolex,
not,
like a watch. Oh, okay,
it's not volatile whatsoever. So I wanted to have that as an asset, and then I have a the rest is all crypto.
Nice.
So the reason I bought a watch was because I knew that it's slightly more. I didn't want to just buy gold.
You gotta stabilize the craziness, of the crypto craziness. Okay.
But the exposure to crypto is like insanely high. But I think I'm pretty sure all of that is my personal stuff. So how can I make it so that I can utilize it from a business standpoint? Because with crypto, it's like insanely hard to track. Like, I don't know, I take out 10K, put it in a paper wallet. The government is like, what the hell? Like, because there's no KYC for if you connect just like a MetaMask or something like that. So
yeah,
they can't really trace it, if that makes sense.
Sure.
How does everything like that work?
It's a multifaceted answer to this, because I think what you're trying to allude to is like a way for the government to not know how much money you're taking in and out. Am I right? Kind of, but also it's like it's really hard to track it as well. So for example, if you invest in like really if you flip really low market cap coins, it can go up and down like crazy, right? So it's a case of, let's say, I don't know, I put in like a Dogecoin.
No, I'm talking even riskier than that. It's maybe I put in $1,000 in I don't know, some random coin that I think is going to blow in the next 2 months, and it goes to zero, but I have another coin that 10x's. It's like the amount of cash coming in and out, and like the profit and losses are really, really crazy. How would I go about tracking that from a bookkeeping standpoint? And also, let's say I make a loss, would that be a tax deductible now, or?
Yeah, great question. So in the US, right, I think they've been trying, it's still wild west, but not as much as a couple of years ago, is that like, say I'm a US citizen and I have a Coinbase account, right? Coinbase is now obligated to track all those in and outs for you, right? And at the end of the year, it's supposed to send you a statement. It's gonna be a crazy long statement if you've done like a lot of trades, but it's all gonna be on there, like every single transaction you make. Now, I'm not sure how in the UK will work. Maybe UK is not at that point yet where they send you just pretty much a tax form, like a tax statement form saying, yo, this is all the in and out, this is all the profit and loss, you made. But in the US, they do that now. They will send you a tax form. And so what I was trying to say, what crypto and real estate, they're in the same category, being that currently the tax law is saying that crypto is basically gonna be treated as a capital gain or loss, like a capital, right? So what that advantage for someone who put money into crypto is that money that they, gain or loss can all be netted out at the end of the day, right? So say, like you were saying, you put 10,000 in a coin and went to zero. Okay, that's $10,000 capital loss, right? But then you have another coin that 10x and you made 100,000 on it. Well, that can net with that $10,000 capital loss. Does that make sense? So really, you have 90,000 capital gain at this point, and that's the part that's subject to tax at this point, right?
Sure.
But it's subject to capital gain tax rate, which is a lot lower than your ordinary tax rate. So capital gain, I think the max is 20%, right? It goes from 0 to 20%. While for ordinary tax rate, where you get charged on your personal income tax, right? That goes from 10 to 38%. So 18% variance difference there, right? So that's why it's still an advantage for you doing in crypto, even though it's not like a recommendation that like a finance background would recommend because of how volatile it is, right?
Sure.
But hey, if you're if you know what you're doing and you can make it work for you, it can be a way to still diversify your earnings, still not to take out cash directly from your business, and you can make a huge payday at the end of the day, right? If you get in the right coin at the right time and 100x something like that, right? So
because with crypto there's like so many really like weird investment vehicles. One of the things I got into about 2 months ago at this point was, I don't know if you've ever heard of Axfinity.
I haven't heard that one.
Well, it's basically like a video game where you play. It's like kind of like Pokemon, where you battle. You either do PvE or PvP, and then you basically like get rewarded SLP or Axie or whatever, AXS, and then from that you can actually trade it into real world value, and you use the currency in game to kind of like breed more Pokemon, essentially, right? And a couple months ago, I started like a farm. So I have gamers in Peru playing the game and grinding this for me. But the incentive here is the Pokemon, like these Pokemon, they're called Axies, they're basically like NFTs. These NFTs are really expensive. So people in third world countries, they can't build their own teams because it's like, each team costs maybe like 1.5K to build, but they're able to play the game and generate income. So that's something that I invested in a while ago, and it's like 2 to 3x the initial investment.
Nice.
But I did it currently it's under as like a director's loan because I was invoiced by like another company who helps me manage all of this. So like, how does that play out in terms of like a tax strategy? Just because it sounds like crazy, right? Because I have Peruvian people playing video games as like an investment vehicle.
Okay, well, at the end of the day, it's that setup is crazy, by the way. But at the end of the day, I think what matters is you as the investor holder, right? Your gain and loss in the investment vehicle, right? So I don't know how crazy it is over in the UK and how much they're governing crypto right now. Maybe it's a lot looser than the US. But if we're talking about a US perspective of it, I would say this program of a US person was in it, right? At the end of the day, it's all about, I put in $1,000. I now have a crypto Axiom thing that's worth $3,000. I 3x my money. That's end of the day. That's what it is, right? That's what all the IRS gonna see, right? Is what is your current value translated to US dollars of the amount thing you have in it, right? Now, if you're talking about like finding different ways where you can say not claim the gains that you have made in that business, that's possible, but you have to do things like set up multiple entities, possibly in other countries, possibly say that this is not a UK source income, right? Maybe it's income that's sourced in a country that's you don't have to pay taxes in the UK, right? There's a lot of laws like that where, depending on where that income is coming from, it may not affect you, right? As a UK citizen. That may be something you can look into as a loophole. It's like, hey, well, if I'm not getting taxed on any Axiom gains because it's all takes place in Peru and UK doesn't care about income I make in Peru, that's a win, right? And that may be something.
So like, have like a separate wallet
Yes,
Gotcha.
that's just for that country. But then you have to make sure that's what your tax law says, right? If your tax
Gotcha.
law does say that you're only getting taxed, like it's like if you're a guy from Singapore, like I was talking about before, that's only care about territorial tax, meaning income made within the borders of Singapore. Well, if you have a Peruvian farm making you money down there, they don't care.
Gotcha.
The government does not have the jurisdiction to look at your Pokemons and how much your Pokemon and your team of laborers down there making you money, it's doing for you.
The crazy thing is, it's like, because my accountant is like slightly more from like the traditional background.
Sure.
I really don't even know how to begin this conversation where it's like, hey,
it's a crazy conversation. I think he's gonna like have his jaws drop, when you try to talk to him about how you're trying to catch Pokemon and make money.
For sure. So I think I really enjoyed this Q&A, first of all. So thank you, Alan, so much.
Yeah, of course.
I definitely learned a lot in terms of the various ways, especially to like defer taxes and also be able to, allocate your funds into things like NFTs and stuff as stores of value. If people want your help with their taxes, what type of people do you help? What's your qualification criteria? And also, how can they actually find you?
Great. So if they are looking for agency help at this point of their business, I would say definitely reach out directly to me. What we usually do is we get on a discovery call with them, and basically that just kind of run through their qualifications, right? But just to give you general terms, like we mentioned, we only help online businesses. That's our niche. We don't take any mom and pop, mortar. If you have a retail store, if you have a doctor's office, we don't handle any of that. We only do online business and e-commerce. That's all we do. And usually what we find is the most optimal tax saving starts when your business start getting about 350K in annual revenue or above, right? So we usually don't take any client that's below that point, right? So 350K and above is when we start saying, okay, there's a benefit of you guys hiring an accountant or hiring a CPA to start looking into your books, looking into your different way of tax savings and optimization for you, right? So we start at that point, and we take from anyone from that to like about 5 million. That's kind of what we try to corner as a market, right? And the reason we do that is, we only want to take on happy clients. We only want to take on clients we can serve and do really well of, because, you run agency too, reputation is everything, right? And we have great word of mouth. So with that, if they want to reach out to me, they can just go on my website, freecashflow.io. They can look around, but if they want to book a call, it's freecashflow.io/book to book a call. But they can also find me on, Instagram, Facebook, on the freecashflow.io.
I'll drop Alan's calendar also in the description of this video. So if you guys want to book a call, feel free to do so. Just to clarify though, you mentioned 350K a year in revenue. Does that mean it's, let's say, because eCom margins and agency margins and like coaching business is like vastly different. So from a profit standpoint, would you say like, is it 100K and above or like 150 above?
Yeah, we like thinking about in revenue terms, because that's easy for people to understand, right? Because when you get down to the bottom line, there's the point of calculating to get to those numbers. So we don't want to deter anyone that could actually use our help. So like in revenue is very easy, right? You just go on your dashboard, be like, okay, this is how much I made this year. Okay, I qualify, kind of thing.
Gotcha.
Yeah, and then we just have a conversation and we just talk through, and if we can help you, we'd love to do so. If we can't, just give you some great tax advice, and hope you keep succeeding in your business.
Awesome. Well, Alan, as soon as you expand in the UK, I'm gonna be working with you. So
okay, we'll try to do that for sure.
For sure. All right, guys, if you enjoyed watching this video, I'm gonna have all of the links to Alan's social pages, websites, callings, everything in the description. Feel free to find him there. He also has like a really entry-level course, really great. I'm also going to link that in the description below. Thank you so much for watching, and honestly, thank you, Alan, for coming on to my channel and talking about this. Really appreciate it.
Yeah, definitely. Thank you so much for having me, and it was a great time talking about tax and accounting stuff, man.
Awesome. Have a good one.
Thanks so much.